Oil is rebounding again, and the real question is not whether prices move another $5 higher or lower. The question is whether elevated energy costs are now exposing weaknesses that were already inside the global economy. I'm Grant Whitmore. On this channel, we look beyond the headlines and focus on the structure underneath the market. Oil is often discussed as an inflation story. That is only part of it. Oil is also an income story, a business margin story, a trade story, and, in many countries, a dollar liquidity story. When crude remains near the upper end of its recent range, households pay more for transportation, electricity, and everyday goods. Businesses face higher input costs. Importing countries need more dollars to pay for energy. None of those pressures arrive in isolation. They reinforce one another across multiple markets. The critical issue is time. A short-lived spike can be absorbed. A prolonged period of high energy prices is different. It slowly reduces disposable income, weakens consumption, compresses business margins, and makes companies more cautious about investment and hiring. The economy does not need to collapse overnight. It only needs to weaken enough for the feedback loop to become self-reinforcing. That is why a decline in oil prices would not automatically be good news. There are two very different reasons oil can fall. The better outcome is supply normalization. Risk premiums fade, shipping routes stabilize, and the market begins to believe the disruption is easing. The worst outcome is demand destruction. Oil falls because consumers are cutting back, trade is slowing, and businesses are reducing activity. In that case, lower oil prices are not a sign of relief, they are a symptom of a broader slowdown. The currency market may offer the clearest warning. Energy importing economies need dollars to pay for crude. When oil rises while dollar funding becomes tighter, currencies come under pressure. Central banks may raise rates or use reserves to defend their exchange rates, but intervention can only buy time. It does not create new dollar liquidity. This is where the oil shock becomes a monetary shock. The important signals are not limited to crude futures. Watch the dollar, short-term rates, front-end yield curves, and the currencies of major energy importers. If oil stays elevated while those markets continue to tighten, the global system is telling us that the pressure is spreading. The market does not always break with one dramatic event. Sometimes the real damage comes from a condition that lasts slightly too long. That is the risk today. Oil does not need to surge to extreme levels to matter. It only needs to remain expensive long enough to squeeze income, weaken demand, and intensify the global demand for dollars. Markets reward clarity more than certainty. The goal is not to predict every move in crude. The goal is to understand the structure, watch the feedback loop, and stay rational as the cycle develops. I'm Grant Whitmore. Thank you for watching, and I'll see you in the next video.